I've had 3 attempts to buy gold this year. I'm talking about physical gold, and I was this time I was down at it's the 4th attempt, big one. What one was not really anybody's fault, but the 4th I went to Degussa, which is a Swiss shop where you can buy physical gold, and once again I was told, "Sorry, sir, there's such a queue. You'll have to wait 45 minutes before you can get to the counter." And I said, "I haven't got 40 minutes. I've got a train to catch," and so I couldn't. This is the 3rd time I've been in there trying to get gold and had the same experience. There's too many people in the door, which I never experienced ever before in the previous year.
Are they buying or selling though?
Well, on the this time I didn't ask, but on the previous 2 occasions that I tried to get in, I asked the question and was told they're buying. And there was a 4th occasion when I tried to buy gold from a different dealer, but it wasn't anything to do with buying and selling. This was when I was in Cron, Montana at the start of the year, and there'd been the fire, and I made the appointment with the thing to come back the next day, and then of course you couldn't get in the street because they blocked off the street because of the Cron, Montana fire. But that's nothing to do with the guy, the seller there. But yes, it was 2 of these 3 times at Degussa, you just couldn't get in the door because there were too many buyers.
Clive Thompson is making 2 core points here. First, physical gold demand is unusually high right now. He's been to Swiss gold dealers multiple times this year and keeps getting turned away 45-minute queues just to get to the counter. He says he's never seen anything like it before. Second, he's drawing a direct parallel to the 1970s stagflation era. Back then, from 1971 to 1980, gold ran at a compound annual return of around 47%, and he thinks we're heading into a similar setup: negative real interest rates, rising inflation, nowhere to hide. Now, is that plausible? Honestly, yes, the structural comparison holds, but here's where I'd push back slightly. In the 70s, Volcker came in and broke inflation with brutal rate hikes. Today, central banks can't really do that. You've got inflation rising on one side and unemployment rising on the other. That's a much harder corner to get out of. So the scenario is credible, just more complicated than a straight replay of the 70s.
At stagflation back in the 1970s, it was extremely good for the gold price over the period from August 1971 through to January 1980, which was a period more or less of all the time of negative real rates. Gold literally soared. Now, it didn't go in a straight line, it's up and down, but if we did draw it as a straight line, it was a compound annual rate of return of 47% you could have had if you bought gold at $35 and sold it at $850 in January 1980. 47%, I think it was, per annum, 46% about, for 8 and a bit years straight. Now, we have had a rise in the gold price of approximately the same amount over the last 12 months, which kind of implies that people are anticipating the same sort of scenario. So if we do go into negative rates, I think we've got many years ahead of us until such time as something is done about it. I personally think we probably could see some months from here of the gold price not really shooting up. I mean, a lot of people are saying it's got to shoot up to the 5,500, the level it was at its absolute peak. Now, I think we will get there, and I think it will go higher, a lot higher. But to say that it's about to happen next week or next month or 2 months, my brain, which is like everybody else looking for patterns, isn't saying that's imminent. But when it starts to happen, you don't want to be running to the gold store like everybody else. You want to be filling your boots at a time when you can still lay your hands on it. So my plan is to continue buying the physical. It doesn't mean to say that you shouldn't buy exchange traded funds and so forth, but I've got my fill of those sort of things. I've got my gold miners, I've got my exchange traded funds. I feel that now is the time when I'd like to have more physical. And of course, I'll keep it in a very safe place where I can go to get it, specifically a bank safety deposit box. You've got to rely on the bank doors being open when you need it, but one assumes that you will be able to get in the door. So I think now is the time to be, while there's still an opportunity to get it before you find you just can't get it at all. And we did actually see that across the world in the run-up to the January peak. People were reporting everywhere that they couldn't get in the door, just as was my experience a couple of times to buy gold, and yesterday as well. Although I think that one of the suggestions was the guy said to me, "You can come if you come as we open. There's less people at that time." So yeah, I think it's just a time to be acquiring now. Price driven, it's a good price. It's we're $1,000 below its peak nearly. I like to buy things when they're not at the peak.
What is your perception of the economy right now, Clive?
Well, the key risk to the global economy is commodity prices. The World Bank has forecast that commodity prices will rise 16% in 2026, and that energy prices will rise 24% in 2026. And there is no doubt that the rising prices of raw materials will feed through to consumer prices at the end of the day. You might think that the central bank is under pressure to raise interest rates to rein in that inflation. But the other side of the problem, which is also on the global economy, we're seeing that unemployment is rising, and we're seeing that employment, the people on people, is falling. So although one can't say definitely that that's a slowing economy, we can say that as far as the man in the street is concerned, his job is more at risk. It's getting harder to get a job. But maybe it's not necessarily affecting company profits, who are benefiting from the increased efficiency of getting rid of their staff. So I think that's the big picture. Obviously, with higher energy costs, it's feeding through to diesel prices, which have risen far faster than petrol prices, and now oil prices falling a bit. They're falling slower than petrol prices, and diesel, of course, is the key component to many things. It's obviously feeding through to the transport costs, because most lorries use diesel, but we've also got, it's used in jet fuel, it's used in agriculture for fertilizer, and of course mining companies are using it too. Well, on the Fed funds rate, I personally believe that the Fed is stuck. It's torn between the devil and the deep blue sea. Do we raise rates to rein in inflation, which is rising, or do we cut rates to try and encourage investment in the economy, to bring back the jobs growth, which is because the fact is there's less people working than a year ago. The unemployment's rising, so logically you'd lower rates. So obviously both of those are mandates that the Federal Reserve has got, to keep full employment and to rein in inflation. But they don't, at this time, they don't go together. It's one or the other, or sit on your hands and do neither.
Let me break Thompson's argument down into three parts. First, the physical gold squeeze. What he's describing at Degussa in Switzerland isn't just a long line, it's a signal. When ordinary people start rushing into physical metal, not ETFs, not miners, actual coins and bars, that tells you something about confidence in the broader financial system. And the data backs this up. As of early 2025, gold crossed $3,500 an ounce. Central banks, China, Poland, India have been buying at record levels. So Thompson's anecdote isn't an outlier. It fits a much larger pattern. Second, the Fed's impossible position. Thompson calls it being caught between the devil and the deep blue sea. That's actually a pretty accurate description. The Fed has two mandates: keep inflation in check and support full employment. Right now, those two mandates are pulling in opposite directions. You raise rates to fight inflation, you kill jobs, you cut rates to support employment, you pour fuel on inflation. What Thompson doesn't mention, and I think it matters, is tariffs. The new wave of trade tariffs is adding a third pressure. It raises input costs while simultaneously slowing growth. That makes the Fed's job even harder than it was in the 70s. Third, commodities and the diesel problem. Thompson cites World Bank forecasts. Commodity prices up 16%. Energy prices up 24% in 2026. And he zeroes in on diesel specifically, which I think is the right instinct. Diesel isn't just fuel, it's the cost of moving everything. Trucks, agriculture, aviation, mining, they all run on it. When diesel stays expensive, even as oil prices dip, that cost doesn't disappear. It gets embedded into the price of food, transport, manufactured goods. That's how commodity inflation becomes consumer inflation. And that's exactly the feedback loop that makes this so hard to control. So where does that leave us overall? Thompson's core thesis is sound. Physical gold as a store of value in an environment of rising inflation, weakening employment, and a paralyzed central bank that's not a fringe view, that's a defensible economic position. My one addition would be this. The reason the 70s eventually ended was Volcker's willingness to cause real pain, 20% interest rates, a deep recession. That option is basically off the table today given debt levels and political pressures, which, ironically, makes Thompson's argument stronger. If you can't break the cycle the old-fashioned way, the cycle runs longer. And gold tends to do well the longer it runs.